So a single ton of invisible gas released from a tailpipe in like 1990 is actually about to bankrupt your insurance company today.
I know, it sounds completely wild when you put it like that.
It really does. But, welcome to today's deep dive. We're getting right into it. Most of us, we've been trained to view this whole issue entirely through an environmental lens, right?
Right, exactly. Melting ice caps, rising sea levels.
Yeah, stranded polar bears, all of that. But today, we are taking things in a completely different and, frankly, like a much more immediate direction.
Oh, absolutely.
We're looking at some cold, hard financial data from a new study in the journal Nature that reveals this is fundamentally an economic crisis.
Yeah, it's not just an ecology problem anymore.
Not at all. The people currently sweating the most aren't just, climate scientists measuring ice sheets in the Arctic. They are the financial analysts, the actuaries, the risk managers, the people who actually calculate global insurance premiums. We are staring down the barrel of a massive impending financial crisis in the global insurance sector.
So, okay, let's unpack this. It's a really profound shift in perspective because when you move away from looking at just, degrees of atmospheric warming and you start actually translating those temperatures into dollars and cents, you start to see these very real fractures in the foundation of global finance.
Because the money makes it real for people.
Exactly. I mean, the environmental impacts are the physical catalyst, obviously, but the shockwaves from those impacts, they're traveling straight into the balance sheets of the companies that literally underwrite the modern world.
Wow.
Yeah, we are talking about a systemic repricing of global risk across the board.
And the numbers detailing those shockwaves are just, they're staggering. Let's look at the core metric here from the Nature study, because I think this perfectly illustrates the delayed financial impact of carbon emissions.
Right, the 1990 data.
Yeah, exactly. So researchers tracked the economic damage caused by just a single ton of carbon dioxide emitted back in the year 1990. And they calculated that between 1990 and 2020, that specific ton of carbon caused about $180 in economic damages.
Right, $180,
Yeah.
and spread out over a 30-year period.
Which doesn't sound like much.
No, in the grand scheme of global economics, that sounds almost negligible, and that's the danger. It basically lulls markets into a false sense of security regarding, like, the true cost of industrial activity.
Yeah, but then the math turns into what feels like a really predatory credit card bill,
Yeah.
where the interest has been secretly deferred for decades.
Oh, totally. It's a massive balloon payment.
Because the projections for what happens next with that exact same ton of CO2 are just wild. So between the year 2020 and the year 2100, that one single ton of carbon, again, emitted way back in 1990, is projected to cause an additional $1,840 in damages.
Yeah. What's fascinating here is the sheer asymmetry of that timeline, and the compounding nature of the damage.
It's a huge jump.
It really is. I mean, the $180 we've already experienced is just a tiny, tiny fraction of the total bill that's already locked in. The economic burden is overwhelmingly weighted toward the long-term future. So the damages we are dealing with right now today, they are essentially just the down payment.
Okay, hold on. I want to make sure we and the listener really understand the mechanism here.
Yeah.
How exactly does a single cloud of exhaust from 1990 just sit around and suddenly generate a bill that is 10 times higher 30, 40, or 50 years later?
Yeah, it's a great question.
What is actually driving that price tag up so drastically?
Well, it comes down to two overlapping mechanisms. You have physical inertia and economic compounding.
Okay, physical inertia, meaning what?
Meaning, physically, carbon dioxide doesn't just warm the air and then dissipate. It actually persists in the atmosphere for centuries, trapping heat. But the Earth's oceans are these massive heat sinks, right?
They soak it up.
Exactly. They absorb that energy slowly.
Yeah.
So the warming effect of a ton of carbon emitted in 1990 doesn't peak instantly. It basically bakes into the global climate system over decades, gradually altering weather patterns, shifting ocean currents. That's the physical delay part of the equation.
Okay, so the physical weather just gets worse later on. But how does that translate to the economic compounding you mentioned?
Well, think about the cascading effects on an actual economy. Let's say a slightly altered weather pattern causes a minor drought in, 1995,
Right.
and a farmer loses 10% of their crop yield. That obviously translates to lost revenue. And because of that lost revenue, they can't afford to upgrade their irrigation equipment in 1996.
Oh, I see where this is going.
Right. So by 2010, when a much more severe heat wave hits, their farm is even more vulnerable. That leads to a total crop failure. The farmer defaults on a bank loan.
Wow.
Then the local bank tightens credit, which means a nearby manufacturing business can't get a loan to expand.
So it just ripples out.
Exactly. By 2030, that entire local economy is degraded. So that $1,840 represents that snowball effect.
Yeah.
Infrastructure wearing down faster, supply chains fracturing, and just the massive opportunity cost of capital.
Capital that had to be spent on disaster recovery instead of, innovation or growth.
Exactly. It's money spent just treading water.
It's basically an invisible tax on future growth.
Yeah.
And I want you, the listener, to really think about your own long-term financial planning for a second here. Imagine trying to set up your household budget.
Good luck.
Right.
Right.
You calculate your income, you feel like you have a handle on your current debts. And then, out of nowhere, a debt from 30 years ago that you thought you had already paid off certainly multiplies by 10 without any warning.
It would be devastating.
It would wipe out your savings instantly. You just can't plan for a liability that explodes like that.
You really can't. And the thing is, the economic models of the past simply did not account for a multiplier effect of that magnitude.
Right.
When you have an asset, say coastal real estate, a commercial warehouse, agricultural land, its entire value is predicated on stability.
Sure.
If the delayed cost of past emissions suddenly subjects that asset to a tenfold increase in risk and damage, the entire valuation just collapses. The delay basically masks the true cost of the activity until it is far too late to simply undo it.
But, and this is a tenfold increase in damages doesn't just hit the country that was actually producing the emissions.
Oh, no, not at all.
Because the atmosphere obviously doesn't care about borders. So that financial explosion is detonating in entirely different hemispheres. We're looking at a massive discrepancy between who is generating the emissions and who is actually paying the bill for them.
Yeah, this concept of cross-border economic damage is really central to understanding this whole crisis. Atmospheric mixing basically guarantees that the physical cause is totally decoupled from the local economic effect.
And the data from the Nature study on this is incredibly specific. For instance, emissions generated by the United States since 1990 have directly caused an estimated $500 billion in economic damages in India.
$500 billion.
Yeah. And furthermore, those exact same U.S. emissions have caused an estimated $330 billion in damages in Brazil.
It's staggering.
It really is. Those aren't just, abstract environmental concepts. Those are massive, quantifiable financial hits absorbed by entirely different nations. But how does that math actually work? Like, if the atmosphere mixes globally, why does the financial burden land so heavily on countries like India and Brazil specifically?
Well, it has everything to do with geographic vulnerability and economic thresholds. So the United States, largely sitting in a temperate climate zone, has a bit of a buffer.
Okay.
If average temperatures in, say, Ohio rise by 1 degree, you might have slightly milder winters and marginally hotter summers. But the local economy doesn't just break.
Right. People just run their AC a bit more.
Exactly. But India and Brazil, however, are situated in tropical and mid-latitude zones. They are already operating much, much closer to the absolute physical limits of human heat tolerance and crop viability.
So a 1 degree shift there literally pushes them right over the edge.
Exactly. Furthermore, those economies have a much higher reliance on agriculture and outdoor labor.
That makes sense.
If it gets too hot to safely work outside in New Delhi for a month, construction just stops. Agriculture yields plummet, the economic engine physically halts.
Wow.
And that's how a baseline temperature shift driven by industrial activity in North America directly evaporates billions of dollars of gross domestic product in South America and South Asia.
But that creates an impossible macroeconomic situation. I mean, if the damages are crossing borders like this, how can any single local economy or national government possibly absorb that kind of external hit without collapsing?
That's the million-dollar question, or I guess the trillion-dollar question.
Right. I mean, governments have budgets. They have strict limits to what they can borrow. If they're constantly diverting hundreds of billions of dollars away from building new infrastructure just to rebuild what was already destroyed, the system has to snap.
Well, governments alone simply cannot carry that weight. And frankly, they don't.
Okay, so who does?
The burden fundamentally falls heavy and hard on the balance sheets of global insurance companies. If we connect this to the bigger picture, the insurance industry is really the ultimate shock absorber for the global economy. Think about it. When a hurricane wipes out a coastal city or a massive flood destroys a manufacturing hub, it's the insurance payouts that actually provide the capital to rebuild.
But right now, from what we're seeing in the data, that shock absorber is failing.
It's cracking under the pressure.
because we are seeing this relentless drumbeat of disasters, right? Hurricanes, floods, heat waves, wildfires. And it's not just that these events are happening more often, it's that their frequency and destructive power are compounding, slamming directly into these insurance company balance sheets.
Exactly. And to understand why the industry is cracking under this pressure, we really have to look at a foundational concept in actuarial math called stationarity.
Stationarity. Okay,
Yes,
well,
stationarity is basically the assumption that the future will generally behave like the past. So for the last century, insurance companies could look at 100 years of historical data to accurately predict the probability of, say, a wildfire or a flood in a given area.
right. They use that historical baseline to price the risk. They calculate the odds. And then they set the premium so that the pool of collected money is large enough to pay out the inevitable claims, while, obviously still leaving a profit margin for the company.
That's how it's always worked. But the delayed carbon penalty we discussed earlier, that massive influx of unpredictable energy into the climate system, has completely destroyed the concept of stationarity.
It's just gone.
Completely. The past is no longer a reliable indicator of the future. Historical data has become virtually useless. Insurers are trying to place risk in an environment that has fundamentally changed.
It's like trying to bet on a sports game where the rules change every 5 minutes.
That's a perfect way to put it.
Right. You analyze the teams, you look at the historical stats, you place your bet, but then suddenly the bases are moved back. The length of the game changes randomly. Half the field is literally on fire.
Yeah, you can't set odds on that.
Exactly. You can't calculate a baseline. So what do the insurers do? If they can't price the risk accurately because the old math is dead, do they just keep raising the premiums infinitely to cover themselves?
Well, raising premiums is definitely the first lever they pull. Insurers are basically forced to hike policy rates, passing that massive mathematical uncertainty directly onto the consumer.
Ouch.
But there is a very hard ceiling to that strategy. Eventually, the premium becomes so high that the average homeowner or business simply cannot afford it.
Right. It stops making financial sense.
Exactly. And what the data shows is that the risk is growing so large and so utterly unmanageable that in many regions we have moved past high premiums and straight into a total lack of availability.
So finding an insurance policy isn't just expensive anymore. It basically becomes impossible.
Yes. We are seeing aggressive capital flight from high-risk zones. The market is just pulling out entirely.
Hold on. So they just hack up and leave. They literally just look at a map, run whatever new projections they have, and say, we literally cannot do business in this zip code anymore, no matter what price we charge.
Yeah, because the margins of error are basically zero now. If an insurer miscalculates the risk in a highly volatile climate scenario, a single unprecedented disaster like a 1,000-year flood that suddenly happens every 5 years, or a wildfire that burns twice as hot and fast as any previous record, could result in claims that completely bankrupt the insurance company itself.
Wow.
They just cannot afford to hold that level of unpredictable liability on their books.
And the knock-on effect there is brutal. It means the homeowner, the business owner, or the local municipality is left holding the bag with zero safety net. If an entire town burns down and nobody had coverage because all the insurers pulled out 3 years ago, that town doesn't get rebuilt. The local economy is just permanently deleted.
It vanishes. And this is exactly why the survival of the insurance industry itself requires immediate systemic changes. We aren't talking about tweaking a few spreadsheets or just adjusting deductibles. It is an existential threat to how the entire sector operates.
So if historical data is toxic and the old actuarial tables basically belong in a museum, the industry has to adapt. Just thinking through the mechanics of this, if stationarity is dead, the first thing I have to do is throw out the backward-looking math, right? They must need entirely new models that actively project the escalating risks of the future.
Yes, that is the first necessary step outlined by the experts. The industry must transition to dynamic, forward-looking modeling.
Okay.
They need mathematical frameworks that actually factor in that $1,840 delayed impact we discussed. They have to integrate the macroeconomic reality of those cross-border damages and the compounding nature of climate volatility. Basically, they have to price in the future, not the past.
So what does this all mean? Let's say they build the perfect dynamic model. It predicts the future flawlessly.
Right.
Isn't that just a Band-Aid? Because if you build a perfect model that predicts exactly how badly a house is going to burn down, but you don't actually put out the fire, the house still burns down.
Right.
The insurance company might have priced the premium perfectly, like maybe the policy now costs $100,000 a year, but the physical asset is still destroyed, and the premium is completely unaffordable for anyone. Just modeling the doom doesn't stop it.
And that is the absolute crux of the issue. Better modeling is an operational necessity for insurers to stay solvent in the short term, but it does absolutely nothing to stop the physical destruction of assets.
Right.
Modeling just accurately measures the speed at which we are hitting the ground. To actually survive this, there has to be a second, much more aggressive step.
It's like a boat taking on water. The new model is just a really, really accurate ruler telling you exactly how fast the boat is sinking. To survive, you have to do two things simultaneously. You have to fix the leak in the hull, and you have to bail the water out.
That's a perfect way to look at it. Fixing the leak is emission reduction, aggressively cutting the carbon output that is feeding the core problem and driving up that deferred economic penalty.
And bailing the water?
Bailing the water out is climate adaptation. We have to physically prepare for the changes that are already locked into the system. We need massive, massive investments in reinforcing power grids, updating building codes to withstand higher wind speeds, and constructing physical barriers like seawalls.
But if we don't fix the leak, if we don't drastically reduce emissions, the water just keeps coming in faster than we can ever bail it out.
This raises an important question about the limits of financial engineering, because the cascading effects of that deferred carbon penalty will eventually overwhelm even the most sophisticated predictive models and the strongest seawalls.
That's just too much force.
Exactly. The starkest warning from this data is that without mitigating the root cause, the burden on the insurance sector will continue to snowball until the math simply breaks. We aren't just facing a physical future with more natural disasters, we are facing an entirely uninsurable world.
An uninsurable world. That phrase just, it stops you in your tracks.
It's chilling.
It sounds like hyperbole until you actually trace the math backward. Let's briefly recap the journey we've taken on this deep dive to see exactly how we arrive at that terrifying endpoint.
Sure.
We started with the delayed penalty, how a single ton of carbon from 1990 bakes physical heat and compounding economic drag into the system, jumping from $180 of damage to $1,840 in the future.
Balloon payment.
Right. Then we explored the geographic mechanisms, seeing how those delayed penalties cross borders and devastate the economies of tropical and mid-latitude countries like India and Brazil. And finally, we traced how that massive, unpredictable financial strain shatters the whole concept of stationarity, landing directly on the balance sheets of global insurance companies.
Right onto the shock absorbers.
Exactly. They are forced to raise premiums to the breaking point, or withdraw from markets entirely, which leads us right to the brink of an uninsurable world.
And the reality of an uninsurable world is what I really want to leave you, the listener, to mull over today.
Yeah. Because modern society operates entirely on a foundation of managed risk. Think about the basic mechanics of just building a life or a community. Getting a 30-year mortgage to buy a home, that requires an active insurance policy.
You can't get a loan without one.
Right. Securing a commercial loan to start a business, build a factory, or develop a housing tract, it all requires insurance. It is literally the foundational safety net of the global economy.
It's the glue.
So if we reach a point where the risk of climate disaster is simply too high and too unpredictable for any company to underwrite, the banks stop lending. And if the banks stop lending, does the entire concept of property ownership, long-term investment, and the banking sector itself eventually freeze up and break down alongside it?
It is a profound and, frankly, incredibly unsettling thought.
Yeah.
When the shock absorber breaks, the entire vehicle feels every single bump in the road until it just shakes itself apart.
It really does. Well, thank you for joining us on this deep dive. Our goal is to take complex subjects and give you a shortcut to being well-informed, and hopefully we've done just that today. We definitely encourage you to think differently the next time you see a headline about a massive hurricane or a record-breaking heat wave.
Look past the weather.
Exactly. Don't just look at the physical environmental impact. Recognize the invisible, compounding financial shock waves traveling right behind it, heading straight for the foundation of the global economy. Until next time.